from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Elon Musk suggests a path to peace for Russia and Ukraine and gets roasted on Twitter, including by President Zelensky himself. We'll walk you through the latest in the back and forth. Plus, Tesla down more than 8% at the close, the biggest one-day drop in 4 months. This after announcing disappointing delivery numbers. How Musk's plan to localize production may help. And Kim Kardashian gets fined by the SEC after promoting a crypto token without disclosing she was paid for it. We'll have the latest. All of that in a moment, but first I want to take a look at the market stocks kicking off the week with big gains after suffering their worst September in 2 decades. Bloomberg's Ed Ludlow has been watching the moves all day. Ed, take it away.
Hey, Em, good to see you. Welcome back. Some green on the screen. You have to take my word for it. That's been a rare sight of late for the S&P 500. This was the best day since July for the tech-heavy NASDAQ 100, best day since August. And we've finally seen this pullback in yields that have been surging so steadily for so long and showed no signs of abating. Really interesting that Bitcoin, in this risk-on mentality we saw in Monday's market, still can't breach $20,000 per token. But in the equity markets, we're coming off the worst quarterly run for the NASDAQ 100 since 2002, the worst quarterly run for the S&P 500 since 2009. There was a lot of green all over the tech space this Monday. You look at some of the movers and shakers during the day, broad-based rally that saw 95 names on the NASDAQ 100 in the green. This is the MOV function on the Bloomberg terminal behind me because I like to show it. It shows us what was going on. A lot of tech names making gains, and one that really stands out is over my right shoulder, Tesla down 8.6%, a really marked reaction to those third quarter production numbers that missed estimates. Elon Musk and co saying that actually a number of cars were left in transit in that classic end of quarter scramble. The last name I'm really looking at is Peloton as well. Really interesting gain after penning in a deal with Hilton. I know we're going to talk about this later in the show, but Hilton going to use Peloton hardware in their hotels and also often offering Hilton members discounts on that going forward. I know you got more on that later on.
Indeed, Ed. There's also this developing story, Elon Musk drawing the wrath of Ukrainians all the way from President Zelensky on down after this series of tweets urging Ukraine to seek a negotiated solution to the invasion by Russia and cede Crimea for good. David Kirkpatrick, founder of Techonomy, is also with us now. But Ed, I just want you to walk us through the latest in the back and forth. It started with a poll by Elon Musk.
Yeah, so Elon Musk has sent several tweets throughout Monday. The kind of 2 key points on them were, first, that he suggested that there should be a negotiated settlement over the war in Ukraine, between Ukraine and Russia. In a separate tweet, and the one you see on your screen, he implies that Crimea, which is an annexation of Russia's, should remain with Russia for good. And, you know, obviously these are strong words for Elon Musk to be saying. What I would also say is he sent a further poll later in the day saying that the citizens of those areas of Ukrainian territory that Russia is currently trying to annex should be, whether or not they should be given their opportunity to vote on their own futures. But there's been a pretty sharp reaction from all corners of social media and diplomatically to what Elon Musk has had to say.
Well, including from President Zelensky himself, Zelensky responding with a Twitter poll of his own. Which Elon Musk do you like more? One who supports Ukraine or one who supports Russia? David, what's your take on all this?
It's a fairly easy one to have a take on, I must say. I think Musk falls prey to a number of dangerous ideas. One is, if I'm so rich, I must be smart enough to do anything to solve anything. That's ludicrous. He also is an attention hog, and his stock dropped today tremendously in relation to the market, which might not even be unrelated. It may be that he's in a bad mood because of that, and he's trying to get attention to distract himself. It's all crazy stuff. He should not be involved in this issue.
Ed, talk to us a little bit more about the reaction that we're seeing here. Obviously, we've heard from President Zelensky. We've heard from David Kirkpatrick now. We've heard from analysts who cover Tesla, who cover Elon Musk's companies. What else are people saying? Yeah,
well, we've heard from Ukraine's ambassador to Germany, Andriy Melnik. I won't show or say what he said in his tweet due to the coarse language that he used, but he essentially implied that no Ukrainian, or I'm paraphrasing, no Ukrainian would now buy a Tesla product in the future based on what Elon Musk had said. That was Andriy Melnik, the Ukrainian ambassador to Germany. This is slightly anecdotal, but many kind of well-followed Tesla fans, Tesla vehicle owners and shareholders who have a presence on Twitter did come out and say, you know, this is not something that Elon Musk should be doing, that, you know, many labeled it as a mistake as well. So it has invoked a pretty broad and sharp reaction, including from some of those that are fans and supporters of both Tesla and of Elon Musk personally.
This, of course, as the takeover discovery process, the Twitter takeover discovery process continues. Kind of a difficult week for Musk last week, I imagine, with that deluge of texts being made public. David, also today in San Francisco, the CEO of Twitter, Parag Agrawal, was deposed in a closed-door session. We're not sure exactly what happened inside that session yet, but what do you make of all of this happening for Elon Musk and because of Elon Musk, really, at once?
Okay, maybe you think I'm a bad armchair psychologist, but even before this development today about Ukraine, it was occurring to me that it might be that this whole falderall about Twitter buying it, not wanting to buy it, being sued, suing, was a bid for attention. It's hard to explain why he would have tried so hard to buy Twitter and then tried so hard to get out of it without any real fundamental changes in the business landscape. My dog just hit his bowl because he has to have attention, just like Elon Musk.
Ed, you know, of course, we're still waiting for headlines to come out of this deposition of Parag Agrawal, but it should be said that Elon Musk's companies actually have had some involvement in the war on Ukraine, especially Starlink.
Yeah, so SpaceX, of which Elon Musk is a founder and the chief executive officer, had for quite some time throughout the duration of the war in Ukraine been sending Starlink equipment to essentially keep the country connected during a time of war. You know, there's fantastic reporting on the Bloomberg terminal and Bloomberg.com about some of the background of how that came about in coordination with the US. But, you know, they are providing that service, they are providing that hardware. And Musk had tweeted earlier on in the war about SpaceX's efforts to get that equipment into the country and how they had been involved in keeping the Ukrainian people online essentially during this war.
All right. Well, certainly this one's still developing. We're going to continue to watch the tweets. Ed Ludlow, our own Ed Ludlow, thank you so much. David Kirkpatrick, Techonomy founder. David, you're going to stick with us and talk about the next story as well. Coming up, the Supreme Court will now weigh in on the future of social media companies and what they are and are not responsible for when it comes to the real-world consequences of content on their platforms. This is Bloomberg. A big challenge is coming to court for social media companies. The U.S. Supreme Court taking up two cases where they'll decide whether social media companies can be sued for hosting and recommending terrorist content. And it's a big test of an old law, Section 230. Let's break it down with Bloomberg's Supreme Court reporter, Greg Stohr, and Techonomy founder, David Kirkpatrick. So, Greg, talk to us about how you're expecting this to play out in court and whether this is something that could divide the court on ideological lines.
Yeah, there's certainly reasons to think it could. This Section 230, which is the big issue, it's the issue that's involved in the Google case. It's the law that generally provides very broad immunity to social media companies for things that their users post. That has come under fire from conservatives, including Donald Trump. And at the Supreme Court, the one justice who has said something about Section 230 is Justice Clarence Thomas, who is one of the most conservative justices. He has expressed concern that it gives social media companies too much liability, and he's been calling on the Supreme Court to get involved for years.
Section 230, of course, is the Communications Decency Act, which for so many years, decades, in fact, David, has protected and shielded these companies from responsibility for a lot of the content hosted on their platforms. David, what do you think is the most likely outcome here?
Well, I'm not a Supreme Court expert, so it's hard to know what I think it is possible that the Supreme Court is taking these cases for ideological reasons. But the bottom line, long-term outcome, in my opinion, is we do need a different regulatory regime for social media and internet content. Section 230, for whatever pluses and minuses it might add to the dialogue, is not doing what it ought to do. And content that shouldn't be up there is up there. The companies are behaving irresponsibly and don't have an incentive to do the right thing. We need change, absolutely.
Greg, give us the bigger picture on these two particular cases and how significant they are to how we might deal with social media in the future.
Yeah, well, let me separate the two out. So the Twitter case that the court has is kind of terrorism specific. It has to do with a law called the Anti-Terrorism Act. And the question is whether the allegation that social media companies, it's actually not just Twitter, but also Google and Facebook, the allegation that they didn't do enough to identify and take down posts by ISIS, whether that's enough to go forward in court. The other case, the Google case, is the broader one that applies beyond terrorism. It has to do with claims that by making recommendations, this is a YouTube case, that by making recommendations about videos to look at, YouTube encouraged terrorism. And the question is whether that is covered by the immunity conferred under Section 230. That says you can't be held liable for what you do as a publisher for just posting content. But the question is, what about these targeted recommendations that are based on users' viewing history and are done by algorithms?
David, if the Supreme Court erodes Section 230 immunity, how dramatic would that be for companies like Meta and Twitter and YouTube?
It depends on how they were to do it. It's easy to imagine a scenario in which it could cause serious chaos in the marketplace. So I don't think we can, if I were the companies, I would be very concerned. They claim to want a rewrite of Section 230, but it's not clear how this is going to play out in a good way for them. I would say quickly on this YouTube case, I think there is a good argument that since Section 230 was implemented in order to indemnify companies against excesses of speech by people they couldn't control, that is logical. But once they apply their algorithms to that content, I don't see Section 230 being a very good defense for their behavior.
Now, across the pond in Europe, Greg, you've got social media companies being questioned with the British ruling that social media was to blame for the death of a teenage girl. What's your take on how that case could potentially impact these?
Yeah, the Supreme Court justices here tend to ignore what's happening overseas. They look at U.S. law, and they, particularly the conservatives, are very proud of not paying attention to what's happening with foreign law. So I wouldn't expect a direct impact. That being said, these justices do read, they understand that social media is controversial, that there are a lot of folks who blame it for a lot of society's ills, and they may feel that way themselves, and we'll have to see when they get to hear arguments probably early next year whether some of that skepticism towards social media comes out from some of the conservative justices.
All right, well, two cases here that we'll certainly be following. Bloomberg's Greg Storr, who covers the Supreme Court, and Techonomy's David Kirkpatrick. Thank you both. All right, coming up, we're going to hear from the pay equity startup Syndio, talking about progress closing gaps across tech and business as a new law is about to shine a light on salaries across California. This is Bloomberg. Ready or not, what your job pays is about to get a lot less private. California has become the latest state to join a quickly growing nationwide salary transparency movement, which means companies like Alphabet, Meta, even Disney will have to comply and share pay expectations for open roles on demand by January 2023. Let's break it all down with Syndio CEO Maria Colacurcio. Syndio out with a new report that shows that, well, most employers aren't ready. So, Maria, let's start with this new transparency law. What exactly will this do, and what will companies have to do as a result?
Yeah, great question. So Governor Newsom signed the law, SB 1162, last week, September 27th. And as we all know, California is the 5th largest economy in the world. So this is going to have tremendous impact because it's any company with 15 or more employees with even one employee in California. So that has a huge, huge ramification on tech. And so what it actually does is it requires companies to include pay ranges on job postings, as you said, starting January 2023, and report median and mean pay gaps and contractor pay to the state starting March 2023.
So, you're out with a new report that shows employers, they're not ready.
Yeah.
How not ready are they?
We released this report today, so it's pretty fresh. And what we found is 2/3 of companies are saying that they are completely unprepared to post salary ranges. And I think a big part of that is because companies don't yet understand why they pay what they pay. And if you don't know that, that's obviously the first question an employee is going to come to you asking once they see those ranges public.
Why is that so tricky for companies to know why they pay what they pay? And even what they pay and where there are gaps?
Yeah, it's tricky because of the old way of doing pay equity analyses. So obviously, this is what we do. We're innovating this with tech, but the old way is to outsource it to a law firm. You get back a report once a year that just tells you your remediation or what you need to pay people to get out of the woods. And you learn nothing about the underlying policies or programs that are driving pay. So companies really need to start using analytics to figure out, are their pay policies and programs actually working as intended? If they say they pay for performance, for example, which a lot of companies say that, but very few actually do.
So let's take Alphabet and Meta, for example. What would this mean for companies like them, which compete with each other for talent, historically are known for paying folks quite well, but like most companies probably have pretty big pay gaps?
Yeah, so the first thing they're going to have to do is get on top of their pay gaps, because starting pay is the biggest factor in any pay equity analysis. So if you have issues, or as a company, if you have a philosophy of start low, stay low, or pay top dollar to the best negotiator, that's going to very quickly catch up with you from a pay equity and median pay gap perspective. You're going to start to have disparities that you can't rule out are because of something like gender, race, or ethnicity. So the way that would address this as a Google or a Meta or an Apple is to make sure you're not doing pay equity analyses just once a year, but you're looking at this constantly as you hire, as you God forbid, have to lay people off. Are you having adverse impact? Are you letting bias creep in? Because bias requires discretion. It's oxygen. And there's so much discretion in these decisions. And the only way to avoid that is to really use data and analytics to make sure you're informing those and guiding those decisions well.
Do you think this is going to impact the labor market? And if so, how? Especially given that we are, potentially heading into a recession.
I think the interesting thing will be to see how this impacts competitiveness in tech talent. So one of the maybe unintended benefits of what's happening with the market right now is we're going to see a little bit of loosening as it relates to that fierce competition for engineers in tech. And so with pay transparency on top of that, now you're going to see sort of that competitive nature of everyone trying to one-up each other on the salary and the packages. Maybe that will ebb a bit because there will be transparency. And so folks will understand exactly what their opportunities and offers are and will be. So it might make the talent race a little bit easier to manage.
And last quick question. I'm just curious what you're seeing in the labor market right now. We've heard about, the Great Resignation, and then we also heard that was kind of been on pause. Employees aren't necessarily moving around right now because there aren't so many choices out there. How would you describe the state of play right now?
Yeah, I think we keep sort of groping around for a term that gets at the essence of what's happening, whether it's the Great Resignation, the Great Reshuffle, quiet quitting. All of it to me is just a massive reflection that we've seen a total fracturing of trust between employees and employers. And so the way to fix that is to really take workplace equity and the tidal wave of pay transparency that's coming at employers through some of these laws and dive right into it, because that is really the way to rebuild the trust that has broken between employers and employees, that I think is kind of a reflection of all these terms that we keep hearing.
All right, Maria Colacorcio, CEO of Syndio, thank you for shining a light on that for us here today. Appreciate it. Meantime, Elizabeth Holmes' prison sentencing has been delayed. The judge overseeing the Theranos fraud case is looking into whether a key government witness gave truthful testimony at trial after her lawyers said he voiced misgivings during a visit to her home. She was found guilty in January of defrauding investors and conspiracy for her role in the collapse of the blood testing startup she founded that reached a peak valuation of $9 billion. Coming up, Tesla shares dropped after the car maker blamed a disappointing deliveries report on shipment issues. We'll break it down next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get back to the markets now. Shares of Tesla falling the most since June after third quarter deliveries came in below expectations. Even so, it was another record-setting period for Musk and co. Dan Ives of Wedbush Securities joining us now to discuss. So Dan, how alarming is this delivery situation to you?
Well, I think at first glance, clearly the street's going to be disappointed. You saw that in the stock, but I believe it's more logistical rather than demand driven. And that's our view, especially coming out of China, a lot of balls in the air. But I do not believe this is demand driven. Ultimately, that's really going to be the narrative now between the bulls and the bears.
So the narrative from Elon Musk is this. He tweeted, smoothing out crazy end of quarter delivery wave to reduce expedite costs and relieve stress on Tesla team, aiming for steadier deliveries intra-quarter. What's your expectation that that will happen?
Well, that's really the balancing act, because if you look, I mean, they've had to pay significant dollars at end of quarters, and some of the logistical challenges they've had in the US and Europe as well as in China. You know, clearly they put a line in the sand this quarter, but obviously investors, they're going to be focused on that Q4 delivery. Can it be 475K, you know, or higher? Because ultimately that's really the focus. I mean, you really need to see this smooth out, but we, you know, to really stress, we do not believe it's demand driven. I do believe it's logistical rather than, you know, anything other. And look, and that's going to be a guilty till proven innocent situation until we hear guidance in the call in a few weeks.
So are investors going to be convinced by this narrative? And you're seeing a pretty strong reaction here, at least today.
Look, in a white knuckle market, and Tesla's held to a higher standard, especially with a higher multiple. It's not what investors want to see. I mean, this was nothing right home about. You can't sugarcoat it. And now it's going to be a prove me. It's going to be in the penalty box till we go into Q4. But I believe, as we've seen before, this is a back against the wall moment for Musk and Tesla and nothing more.
Meantime, you've got Elon with a lot of things going on. This big Twitter takeover trial set to start in just a couple of weeks. How worried do you think investors are about all of these other potential distractions?
Yeah, look, it's created a bit of a perfect storm. I mean, if you look, you know, you have a soft delivery number. You got the Twitter trial coming up October 17th, and then just an overall risk-off market. You know, I think going to Twitter trial, that there's a lot of questions. Is there a settlement before the trial begins? If not, you know, then it starts to ultimately be a cascade where you could see Musk, you know, still what I believe is owning Twitter at $54.20. We believe a settlement likely could happen before, in the high 40s, $50 range. But once he steps into court, it's likely he's either going to own Twitter or have to pay a $5 to $10 billion settlement. And that's definitely been a bit of what I would say, you know, is another cloud over the Tesla story.
Well, and, you know, I don't know if the perfect storm can get even more perfect or more stormy, but you have Elon setting off an uproar with this series of tweets suggesting negotiation between Ukraine and Russia. A lot of folks commenting on this, analysts commenting on this, all the way up to the president of Ukraine himself, Volodymyr Zelensky, clapping back with a poll of his own. You know, as somebody who follows Tesla and Musk so closely, you know, what's your take on this, and you know, the potential impact it can have on real world companies and real world investors who put their money behind Elon Musk?
Look, they're black eye moments for Musk because it goes back to, instead of staying in his own swim lane, you know, he just adds more and more controversy. And obviously Twitter, you know, as we've seen, that sort of had a cascade effect. And ironically, he could own Twitter as a platform, right? So that just creates more worries. And I think this has just been a broader, what I'll call really a nightmarish 9 months, you know, for Musk, not necessarily for Tesla. And it's something where investors, patience is wearing thin. In this type of market is the last thing you want to see. And it speaks to some of the frustration that you're seeing, because I think today was a lot of frustration selling. You do an AI day on Friday, and then you have a soft delivery Sunday morning. It's not a good look.
Yeah, and then you have frustration from some of Musk's biggest supporters and his own Tesla fans about this latest series of tweets. Of course, the next couple of weeks are going to be very interesting as we head into that Twitter trial. Dan Ives of Wedbush Securities, always good to have you here. Thank you. Meantime, I want to talk a little bit about Peloton and that deal with Hilton to put its exercise bikes in Hilton's 5,400 U.S. hotels. Peloton will also offer members of Hilton's Honors Program a free trial to its app and $100 off a bike or a treadmill purchase. Bloomberg's Mark Gurman with us now for more. Mark, how significant is this deal?
It's just one of a few at this point. Peloton is basically pulling every lever they can pushing every potential partnership they can, doing whatever they can to reverse this sales fall and the stock price decline. I remember when the stock was well north of $100 about a year ago per share, we hit an all-time low for Peloton. I believe either today or on Friday, coming in at under $7 a share. This Hilton news brought the stock up a little bit. Now it's a little bit north of 7, still below 8. You can see right there, it's about at $7.47. So clearly things are not looking so hot for Peloton, with the stock price at its worst point really ever. And they're hoping that more and more of these deals will help turn that around. I'm not certain that this Hilton deal on its own will do much for the company. We're talking about 5,400 hotels here. I believe it's probably only going to be 1, 2, or 3 bikes per hotel. So we're talking about 20,000 units, maybe 25,000 units at the very most. And that's really not going to move the needle for the company. But I think what Barry McCarthy, Peloton's CEO, has said about better prioritizing the digital app and better prioritizing the subscription instead of the hardware is where Peloton is going to be long term. The question is, does Peloton have enough money and runway, investor patience, board of director patience to really see that vision through?
You've, of course, reported on the rowing machine as well as some of these other partnerships. We've seen some departures. The CMO, Dara Treseder, just left. You know, what's your understanding of the level of confidence under Barry McCarthy from the rank and file at this point?
Yeah, I mean, at this point, you know, Barry and that new leadership team has implemented this plan. They're executing this plan, and they're doing exactly what they said they would be doing. They really changed how the company functions operationally. They're allowing the company to generate more margin and more profit. They plan to shut most of their retail outlets next year in 2023. So they're doing everything they possibly can. Unfortunately, for the stock price for the company, that's not changing anything. And as we know, a lot of the employee pay at companies like Peloton is very much tied to the stock. So it's very difficult at this point for the morale to be sky high or anything very positive when they see that they're trying everything they can possibly do. They're moving pretty quickly, right? They've done a whole revamp of their operations in just a matter of months, and it's not doing anything for the stock price, right? In fact, the stock price is just going lower and lower and lower. So I don't think morale is very good at this point.
Right. All right. Mark Gurman, as always, thanks for your reporting. Okay, coming up, as we head into fall, where is the crypto winter headed? We're going to talk about that and more as the SEC slaps Kim Kardashian with a $1.3 million fine for promoting crypto without disclosing she was paid to do it. CoinShares CSO Meltem Demirors is with us to discuss next. This is Bloomberg. Time now for a crypto report, and we've got to talk about Kim Kardashian, who just got fined by the SEC. The reality star will pay close to $1.3 million to settle allegations that she broke U.S. rules by touting the crypto token Ethereum Max, but without disclosing that she was paid for that promotion. Let's talk about this and more with CoinShares Chief Strategy Officer Meltem Demirors and our crypto contributor Sonali Basak. So, Meltem, I gotta ask for your take on this Kim K situation getting fined by the SEC. It's kind of a big deal.
It is. I mean, Kim Kardashian is one of the most influential people on the internet. She has hundreds of millions of followers. But I think there are two big issues here. Number one, the SEC doesn't oversee advertising. The FTC does, so this should be an FTC matter to begin with. And number two, in order for these allegations to be true, Ethereum Max or the EMAX token has to be security. And I have not seen a statement come out or a ruling come out from the SEC to indicate that. So while it's an attention-grabbing headline, I think it's another example of Gensler's SEC pursuing rulemaking via litigation, which is disappointing.
It's interesting you say that because we just interviewed Katie Hahn of Hahn Ventures last week, and she also believes that Gary Gensler's approach is creating a lot of confusion. Take a listen to what she had to say.
I'll just tell you what I hear from founders is that they're very confused because they get told, come in, register, just come in and talk to us. But you have the one company who's done the ultimate act of going in and registering. Coinbase filed an S1. And still, there's a lot of saber rattling still going on, I think.
Malcolm, what do you think? Is there a lot of confusion happening because of regulation, or is the SEC, is trying to create a path to a little bit more certainty, along the lines of, yes, there could be consequences if you do something that we believe is wrong?
I absolutely agree with Katie's perspective, and great respect for Katie. She has been in the belly of the beast. She's been on the Hill. She's seen how these policies get made. I do think it's really confusing. And one of the biggest costs for crypto companies and crypto projects today is compliance. These are early stage financial technology startups, and they are spending millions of dollars not only on trying to untangle current rulemaking and the alphabet soup of different regulators in the United States who they may need to engage with, but also given the precedent that's been set, they need to set aside a lot of capital for future litigation. So I think it really hampers innovation. It really hampers the ability for innovators to compete. And it definitely favors larger financial institutions who have relationships on the Hill, who have lobbyists, and who have pre-existing relationships with these agencies. So I would love to see clarity. I have not seen it yet, and I think it's a huge challenge going forward.
Malcolm, what about other agencies? Because, the SEC is obviously moving in a very different direction than it has the last several years prior to Gensler when it comes to crypto enforcement in particular. But then you see something like the CFTC recently suing a DAO. And I'm wondering if you look at the agencies overall, even despite the issue of is it a security, is it not a security with the SEC, how complicated is it to navigate the web here of agencies that are going after different types of investment vehicles in crypto?
Well, as I said before, it's alphabet soup. There's so many three-letter acronyms. There's so many different agencies. It started really with the CFTC and the SEC. Now there are a number of different agencies involved. Intelligence is involved. If we look at the recent Tornado Cash OFAC issues and sanctions issues, if we look at some of what's happening on the Russia side with people concerned about money movement, there's a lot to navigate. There's not a whole lot of clarity. Now, the Biden administration did put out an executive order, but again, how long will it take for the research phase to move forward? How long will it take for actual practicable policy to be implemented? I haven't seen it yet. I've been doing this for 8 years. I am hopeful, but I've not been impressed by what I've seen so far. And I think the challenge is the blockchain doesn't have a physical jurisdiction. Unlike the banking sector, there is no CEO you can call. It doesn't have physical jurisdiction. So some of these issues are just really nuanced and I think challenging to untangle without really understanding what it is this technology does. So I empathize, but I'm also incredibly impatient because this is a very, very expensive process.
Well, speaking of impatience, you recently tweeted that VCs are going to start asking for refunds. What do you mean by that?
Yeah, look, I think 2021 was the year of the crypto VC. We saw a ton of new funds, a lot of money coming into the space, crazy valuations. Last Q4, we had an all-time high, close to $7 billion of crypto deals done, which comprised for the first time close to 6% of the total for venture. Doesn't seem like a lot, but that's a lot for a fairly nascent sector. Now reality is setting in. People are realizing a lot of these businesses don't necessarily have a pathway to revenue. Burn was really high. People are spending a lot of money. So I think over the next few quarters, we're going to see consolidation. We're going to see less deal making, and we're going to see fewer exits in the form of M&A, in the form of IPOs, and even SPACs, which a lot of investors and their LPs were counting on to deliver those returns.
Something we're talking about at length tomorrow, I know, during our weekly crypto show is the idea here of traditional finance versus DeFi. And, how much does traditional finance still need to move and mold when you are still seeing crypto? Of course, the market value has gone down for a lot of these tokens, but money being raised that way through DAOs. Clearly, a whole generation of young people thinking about investing differently. And so if VCs are asking for their money back, the IPO model is under question, so are SPACs. how important is it for cryptocurrency, crypto markets, blockchain to be a new part of the financial system, even within the existing companies?
Here's what's really exciting. So even though the cryptocurrency market cap might be down, what we see is the integration of cryptocurrencies, digital assets, and blockchain technology into the financial system is continuing at a really rapid pace. So we see firms like Apollo, KKR, BlackRock, Fidelity, just to name some, that are not only offering asset management products or bolting on crypto, they're actually looking at innovative ways they can use the underlying technology to deliver products and services better, faster, cheaper, and in new ways. So I'm really excited about this trend. It's not necessarily cryptocurrency in the traditional sense, but I think that a lot of institutions are looking at the speed at which money can move, some of the programmatic capabilities of DeFi and being able to actually program financial assets digitally on a global medium. And that's really exciting. So I think we're going to continue to see that integration between traditional financial services and the crypto sector. Will it be digital assets in the sense that these are assets on a public ledger? Absolutely. Will it be cryptocurrencies specifically? I think that's an open question. You can create anything and call it a cryptocurrency. I think institutional adoption is still limited to a fairly small set of proven cryptocurrencies. But I think, again, that integration is starting to happen. And that is an area that we at CoinShares are just really excited about.
All right, Meltem Demirors, Chief Strategy Officer at CoinShares. Thanks so much for joining us, as well as our own Sonali Basak. Appreciate it. Coming up, can it become the Beyond Meat of carbs? We're going to talk about the new startup Better Brand and their new low-carb bagel next. This is Bloomberg. A bagel with 90% fewer carbs. That is what a new celebrity-backed bagel venture is promising. It's called Better Brand, and the startup has raised more than $5 million. Let's talk about it with Bloomberg's Priya Anand, who investigated. And Priya, I assume this involved a taste test. Okay, they say every bagel contains the same sugar content of a stalk of celery and the protein content of 4 eggs. Does it actually taste good?
You missed the taste test that we had in the office a couple days ago, Emily, but the consensus among Bloomberg staffers was that it doesn't quite taste like a bagel. And by doesn't quite, most folks thought it was pretty far off from a standard bagel and a grocery store bagel.
So what's the broader consensus here? And not that, our Bloomberg team isn't enough, but is this company having success?
Well, this company actually has just rolled out across various supermarkets. They had a big rollout in Whole Foods. It's in the frozen section of Whole Foods stores now. They've got a couple different flavors, classic, cinnamon. They've got a pumpkin spice flavor for the holiday season. They have a chocolate chip flavor for those who love sweets. And they seem to be expanding quickly. They're looking to roll out in Europe and across Latin America as well. And they're closing another round of funding, they said, pretty shortly.
There's a bigger question here. Can you call it a bagel if it's not full of carbs? Or is it something else entirely? I wonder. But you've got Alexis Ohanian backing the startup. There's some celebrity folks involved. Is there a need, maybe, a real need that they're filling here?
Well, the company says it wants to be the Beyond Meat of carbs and create a very low carb bread line for folks who maybe have health issues and can't eat as many carbs as are in a standard loaf of bread or a standard bagel. And, this could be a substitute for folks who are really trying to change their diet in a very specific way, right? So while it doesn't necessarily taste exactly like a standard bagel, there might be folks out there who say, you know what, this resembles it, it evokes that memory for me in some kind of way. And it is attracting investment from some Hollywood celebrities as well. And so the company says it plans to expand into other bread products like pretzels, eventually have its own ready-made pizza bagel option as well in the frozen aisle. And they're also talking to airlines about putting this in airport lounges.
All right, well, I'm going to need to do a taste test, Priya.
Next time you're in the office.
So maybe you can see if there are some leftovers. Thank you. Bloomberg's Priya Anand, thank you for joining us. And that does it for this edition of Bloomberg Technology. Make sure you tune in tomorrow. Our conversation with Cisco's Chief People Officer, Fran Katsoudas, will be joining us, how Cisco is approaching hybrid work and the future of the office. I'm Emily Chang in San Francisco. This is Bloomberg.